Yes. Thank you very much for your patience. With this, I'm delighted to welcome you all on behalf of RBSA Advisors. My name is Rajiv Shah. I'm the Managing Director and CEO of RBSA Advisors. Today we have, first of all, beg your pardon for some technical glitch, as always happens. Getting great things together, there are always some last-minute technical glitches, but I think we have sorted that out. We have two of the most eminent speakers and professionals with us. We have Professor Aswath Damodaran, with who I don't think there is no introduction required for Prof Damodaran. He is a doyen of valuation, the guru of valuation. Almost everything that all of us have learned have been learned reading his books, and he's a very gracious, very person. The first time I met him in New York, in fact, I called him on his landline and I requested for a meeting. And he said that come right away, there's no appointment required. And I stepped in first time in Manhattan in New York Stern University, and he was very, very gracious. He gave me almost 1.5 hours of his time, explained all the intricacies of valuation. Very, very gracious. In fact, he even gifted this book to me, which I always preserve, and this is what he gave it to me, and this is several years ago. And he has been in touch, and I always seek his guidance, and not just me. I think the valuation fraternity needs his guidance. We have him as a great speaker today, and as a testament of that, we actually ran out of registration space. Today, as we are speaking, more than 1,400 people are on the call, and we look forward to receiving a great presentation from you. And of course, there will be questions and answers after that. For audience, there is a link for the chat box, and I would request if you could post your questions there. But before that, for introducing and welcoming Professor Damodaran, I have invited and requested Dr. Sahu, who has very graciously consented to come and be here as the chief guest. Dr. Sahu again needs no introduction. He has been at the forefront of development of valuation profession in India, for regulating it, developing it. Again, he's a thought leader in itself. He's in fact was a member of SEBI and several government organizations and government committees. He's an eminent professional himself. Single-handedly, he has, and along with his team, of course, he has created the whole insolvency framework in India. I would request Dr. Sahu to welcome Dr. Damodaran and take things further from there. Dr. Sahu, sir. So your phone is on, it seems it's on mute, sir.
Thank you. Thank you, Mr. Saha. I just saw a flyer from Mr. Saha to the effect that RBSA presents Damodaran on valuation. So I just wanted to grab the opportunity to listen to Professor Damodaran and circulated the flyer among my colleagues. Mr. Saha not only agreed to allow us and my colleagues to hear Professor Damodaran, he also invited me to speak a few words at the beginning. Professor Damodaran would not remember me. In fact, I had met him also in 2009, I think, in his office. Then I was a member of SEBI and took a lot of guidance from he also, like you told, he had also given about an hour's time at that time. But then I was no way associated with the valuation. I was on the securities market. So anyway, considering the opportunity to hear Professor Damodaran, I agreed to Mr. Saha to pay the small price of speaking for 2-3 minutes. But I do not wish to stand between you and Professor, because if I do so, I will deprive myself from learning from the Professor. So as I told, I'll just take 2 minutes to tell my interest in valuation. At the Insolvency and Bankruptcy Board of India, we are one of the major users of valuation services. When one needs medical services, he looks for a person who is competent, who is authorized, who is accountable for medical services. Similarly, when I look for valuation services, I am looking for someone who is competent, who is qualified, who is authorized, who is accountable for valuation services. That means we are interested in a valuer who is professionally, who has a professional qualification as a doctor has, and who has accountability as any other professional like a doctor or chartered accountant has. And simultaneously, he should also get respect of the society as another professional. And this, if he gets the right respect, this would in turn attract the talent to the profession who will study this profession as a regular course and practice as a regular full-time profession. And they will have the authorization, regulation, development, all that Mr. Saha mentioned about, so that customers, the clients have some minimum quality of assurance. So let me give an example from the IBC area. It's an insolvency proceeding. There's a requirement that two valuers will conduct a valuation of a company to arrive at fair value and liquidation value of that company. These are not the prices which market discovers, and nobody has means to know what the price of the market value is. But we expect the valuer to produce a value which is more authentic than the price itself. In a sense, a valuer competes with the most powerful creation of man, that is the market. And market discovers a price, and we consider that price to be the most authentic value of the product. But the market can go wrong, may discover dirty prices sometimes, but we expect the valuer must not give an estimate which is somehow dirty. He should produce a value which is more authentic than the price itself. This is the kind of professional we are looking at, because depending on the value he gives, the committee of creditors compares how much the market is willing to pay to take over a company or to pay to the creditors to discharge the obligations of the company. So he compares the value he gets from market sources, which could be a bad value or good value, but he has got a value, more authentic value from the valuers, and we are comparing these two for a decision as to whether we reject the proposal, whether we liquidate an otherwise viable company, or whether we rescue an otherwise unviable company. This is the importance of the profession in the IBC space. Keeping that in view and requirements of economy in other segments, though the country has the valuation profession for over 50 years now, we know that there is no systematic effort or an institutional framework responsible for development and regulation of the profession in a holistic manner. Keeping that in view, we made some progress under the Companies Act over the last 3 years. There are standards including the examinations, and I must tell that the study material prepared by the CVSRTA for IBBI in the area of plant and machinery, land and building are today used internationally. Say, for example, the European Group of Valuers Association or the Australian Property Institute, they use this study material in these areas prepared by our people. In a sense, these are now internationally accepted standard study material. But we wanted also to move one step further from rules to a statutory framework. Government recently set up a committee, and the committee had submitted a report giving a complete institutional framework, and that is under examination. Elsewhere, we have discussed the features of the institutional framework. Maybe some other time we'll discuss that. But as of now, there's a proposal under active consideration of the government to provide a formal, regular institutional framework that holistically develops the profession, which gets respectability of the society while holds them accountable for their services. We hope as the work happens, as we progress further, this is the time to learn from Professor Damodaran and other such people. So we build the knowledge base, we develop the valuation as a discipline of knowledge. With this, I close and thank you, Mr. Shah, for inviting me. And now I look forward to hearing Professor Damodaran. Thank you.
Thank you, sir. Thank you. It's all up to you, sir. Over to you, Prof. We look forward to being dazzled. Thank you.
Can you hear me now? Yeah. So I over the last few months, I've learned to live with technology and die with technology. So my original plan was I was going to show you some slides and take you through. But you know what? You've got the slides, the link to the slides already. There are 44 slides. I kind of remember what's on those slides because I didn't write them that long ago. So I'm going to wing it. So if the slides keep up with me, great. If not, not a big deal. So what I'd like to do is talk a little bit about what I've learned during this crisis. And let me explain what I mean by learn during a crisis. Three things happen during any crisis. The first is in the midst of a crisis, you lose perspective. You basically, you're so caught up in what's happening during the crisis, you can't even think about anything else. That's the first thing that happens. The second thing that happens is you lose faith. Faith in what everything you thought you knew starts to become shaky. You say, is that true? Is that right? And the third thing that happens is you look outside for advice. You want experts to tell you what to do. You're no longer comfortable with what you know. You lose perspective, you lose faith, you outsource your thinking. It happens in every crisis. And I'm a human being, just like you. Those same things happen in the first few weeks of this crisis. And so over the last 18 weeks, I've been struggling with what I'm learning during this crisis. And one of the things I've been doing, and I'll draw your attention to it in case you're interested, is on my blog, I've been keeping pretty much what I think of as a personal journal of what I'm feeling at that time and what I believe is happening around me. It's taken the form of 11 posts that I've put up on this crisis. I'm on my 12th post, should come up today. But there are 12 posts on the crisis, but I want to record in real time what I'm learning and what I'm thinking. Because here's why I want to do it in real time. Once a crisis passes, we very quickly forget about the crisis. I remember in 2010, I was giving a talk at an investment bank in New York, and I talked about the crisis. I mean, this is a year and a half after the 2008 crisis. And a young banker puts up his hand and he says, what crisis are we talking about? This is in 2010. He'd already forgotten about the crisis. But that's part of being a human being. We tend to forget bad things, we move on. But you need to remember what's happening in the midst of a crisis if you truly want to learn from it. So what I'd like to do is take 5 lessons I've learned in the course of these crises. Now, these lessons are not new lessons. Some of them are lessons I already knew that I'm relearning. Some are new lessons, and kind of talk about them over the next 45 minutes because I want to give you some time to ask questions if need be, kind of interaction. So here's the first lesson. So if you have my connection to the slides, you can go to slide 2. Here's my first lesson. When you're when you look at markets, especially over the last 5 months, what are you told? Markets have gone crazy, markets are irrational, markets do strange things, right? And you've heard that. Markets are chaotic. And as I listen to experts tell me markets are chaotic, I look at what the experts themselves are saying. And it's very convenient for them to talk about markets being chaotic when the advice that experts give me swings from day to day. They tell me to buy on one day, sell on the next. I mean, markets reflect what we collectively feel as human beings. Markets are not magical machines. They're essentially a consensus view of what investors collectively feel. And let me ask you a question. As you look out of your window, it's late night in India, so it might be dark outside, ask yourself, what's going to be happening a week from now, a month from now? Let's face it, none of us knows what's going to be happening a week or a month from now. We don't know whether we'll be back at our jobs. We won't know we have no idea what's going to happen. And if you feel uncertain, think about everybody else around you. We all feel uncertain. Why do you think markets are somehow going to be exempt from this? So cut markets some slack. If markets are volatile, they reflect the collective uncertainty we all feel as human beings. It's human nature. So I'm going to say something about markets, and if you turn to the next slide, you'll see a picture talking about the difference between price and value. Markets in the midst of a crisis play what I call the pricing game. You're saying, what's the pricing game? There are 2 words in investing we use interchangeably that we should not. The first is the word value. The second is the word price. We know what drives value: cash flows, growth, and risk. And as Dr. Sahu was saying, and appraisers are taught this process: do discounted cash flow valuations, bring in the cash flows, adjust for the risk, come up with the value. I'm a believer in intrinsic valuation. And I agree that value is driven by cash flows, growth, and risk. That's always been true. But you know what drives price? It's demand and supply. What drives demand and supply? Well, it could be cash flows, growth, and risk, those fundamentals we talk about. But it's also driven by mood and momentum and liquidity, the magic of what makes markets work. And the reason I emphasize that is the pricing process can yield a very different number than the value process. Let's start with that as a given. Now, the pricing process delivers price, the value process delivers value. If you lived in an efficient market, the two words can be used interchangeably, but the reality is we don't. So one of the things I tell people who call themselves valuation professionals, and a lot of you do, is ask them, is your job estimating value or is it estimating price? They look at me like I have two heads here. What are you talking about? Most of your valuation jobs are really pricing jobs. Why? Because people want a number that they can sell things at, that they can estimate, that they can get if they sold their business. Much of what passes for valuation is pricing. And in the midst of a crisis, markets play a pricing game. You're saying, so what? If you turn to the next slide, there I highlight three different areas where the pricing process and the value process can diverge. Here's the first one. The pricing process has no upper bound or lower bound. Let me explain what I mean by that. If you ask me what the highest price Tesla can trade at, you know how well Tesla's done this year? It's tripled in price. The stock looks like it has no upper limit. If you ask me what's the highest price Tesla can trade at, my answer is I have no idea. If you ask me what's the lowest price, I have no idea. The pricing process is no upper bound or lower bound, but the value process does. If you're an optimist on Tesla and you value Tesla, you will have much higher revenues, much higher margins, much lower discount rates, a much higher value for Tesla. But there's a limit to your value. And if I value Tesla and I'm a pessimist, I'll have lower revenues, lower margins, lower discount rates, lower value. But value works within bounds, price is unbounded. That's the first difference. Second, price is reactive. I mean, when people talk about trading, they talk about playing the pricing game. How do you make money in the pricing game? You buy at a low price and you sell at a high price. And to play the pricing game, you know what you got to be really good at? Not estimating value, but engaging mood and momentum. I don't know whether any of you have read or heard about Lord Keynes' description of the stock market. You know how he described the stock market? He described the stock market as a beauty contest. But he said, in this beauty contest, if you're the judge, your job is not to judge who the best looking person on the stage is, but who the other judges think the best looking person on the stage is. In pricing, your job is to not decide how much Tesla is worth, but to decide how other people think Tesla is worth. Pricing is reactive because you have to constantly scan the crowd and say, do they like it? Do they not like it? Value is proactive. To value something, you always have to look forward. One of my problems with the valuation profession is it's become too backward looking. How do you get your numbers? You look at historical data. How do you get your risk premiums? You look at past data. We're so reliant on the past, we've forgotten that value is all about forecasting the future. And there's a third difference. I told you that price and value can be different. You're saying, but they have to converge. And I'm going to be sacrilegious here and ask why. There's nothing in this process that requires that price and value have to converge over time, which means you can be right about value and you can go bankrupt. And your neighbor can pick stocks based on astrological signs and make millions of dollars. There's no justice in this world. There's no requirement in this process that price and value have to converge. So if you turn to the next page, you're going to see one of the things that comes out of this process is what equities have done during this crisis. So and this is a US index-based perspective. I'll kind of broaden it to the global markets. But I've actually taken US equity indices, in this case, the S&P 500 and the NASDAQ. So you see this on slide 5. And I've graphed them over time. Over time when? I started my crisis clock on February 14th of 2020. You see, what was special about the day? On February 14th of 2020, US equities and European equities headed all-time highs. The market was doing really well. And everybody was convinced that this virus was a virus that was going to stay in Asia, that was going to affect the rest of the world. And we were in for a rude awakening. So on February 14th, Italy announced that they'd found a couple of hundred people, because until then, all of the cases had either been in Asia or had been on cruise ships that had been to Asia. But Italy announced that a couple of hundred people in Italy had the virus, and they'd had no connections to China. The world woke up to the crisis. You know what happened over the next 5 weeks? Markets imploded. Take a look at what markets did. I called it the meltdown between February 14th and March 20th. Equities in the US dropped by 30%. And I expand this globally. This was a global phenomenon. Stocks all over the world went into meltdown. If the definition of a bear market is that stocks drop 10% from a high, we had 3 times. We had a terrible bear market happen in 5 weeks. So by the time you got to March 20th, if you were reading the news, you were convinced the end of the world was here. I had more calls in the middle of March from relatives I didn't even know I had saying, should I sell everything? Is this the end of the world? And markets, no, the mood can shift. This is something about markets that we need to recognize and respect. We have no idea what caused this to happen. And maybe I'll give you some clues in a couple of minutes. But around March 20th, equities seemed to turn on a dime. And between March 20th and May 22nd, if you take a look at the next 2 months, equities had a huge comeback. You had a bear market. You had a bear market in the first 5 weeks. You had a bull market over the next 2 months. And then since May 22nd, we've been in a consolidation phase where stocks have continued to drift down. I want you to hold on to this thought because this is something that played out across markets. So let's go from equities. We go to the next page to US Treasuries. You're saying, why look at US Treasuries? One of the things that happens in every crisis, you have what's called a flight to safety, a fancy way of saying if people get scared, they sell risky assets and they try to invest in something safe. And for better or worse, for much of the last century, US Treasuries have been viewed as a safe investment. Now we can debate whether they're safe or not, but they've been viewed as safe. So as people were selling stocks in those first 5 weeks, February 14th to March 20th, they were getting cash from selling stocks. They had to put the money somewhere. You know where they put them? They put them in US Treasuries. When that much money comes into US Treasuries, guess what it does? It pushes up Treasury prices. And if you look at the next page, you'll actually see US Treasury rates over the same period that I looked at stocks. And take a look at US Treasury rates. Between February 14th and March 20th, and so this is on slide 6. Between February 14th and March 20th, you will see Treasury rates across the board decrease. T-bill rates, T-bond rates, 10-year, 30-year rates drop. Just to give you a sense of perspective how much they drop, T-bill rates dropped to close to zero. T-bond rates, which were around 1.5 to 2%, dropped to about 0.7%. And all of this happened before the middle of March. You see, what's the big deal about the middle of March? The Fed actually did not make its first big announcement till March 15th, when it announced it was going to expand quantitative easing, but interest rates had already dropped. The reason I emphasize the sequence is the story that's often told for why interest rates have dropped is that the Fed did it. But you know what? Rates had already dropped before the Fed acted on March 15th. And on March 23rd, and this to me was a turning point for the market, the Fed acted again, increasing the quantitative easing. But it also announced something that I think made a big impact on markets. It announced that it was going to be a backstop in the corporate bond and lending markets. In other words, the Fed said, we will come and buy corporate bonds to stop them from dropping. We will lend money to companies that are truly in trouble, something that the Fed almost never does. That turned the market around, but rates had already dropped. They've stayed low. In fact, I describe US Treasuries as having gone into a coma once it got to March 15, because you look at the rates, once they dropped, by the middle of March, they've stayed low since. So stocks dropped and then reversed. Treasuries dropped and they've stayed low. As all of this happened, the corporate bond market was also feeling the heat. Because remember, as people get scared, they demand larger yields on corporate bonds. They worry more about default risk. And the way this showed up, if you look at page 7, is the default spreads on corporate bonds increase across the board. AAA, AA, single A, triple B, double B, single B. Take a look at every single rating. Take a look at what happened to default spread between February 14th and March 20th. While stocks were dropping, default spreads were widening. The triple B rated default spread, for instance, almost tripled over 5 weeks. It went from about 1.33% all the way almost to 4% by March 20th. And then take a look at what happened after March 20th. Like magic, you see the spread start to decrease again. As investors get less scared and they go back into equities, they're also decreasing the default spreads on bonds. So equities dropped and reversed, treasuries dropped and stayed low, corporate bond spreads widened, and then they started shrinking again. Now, along the way, as I was looking at the financial asset markets, I also decided to look at two commodities. So you look at page 8, you will see the two commodities I've tracked over this crisis. One is oil and the other is copper. You're saying, why do you pick those two commodities? They're both economically sensitive commodities. They both should reflect what people think will happen to the global economy. And in the first 5 weeks of this crisis, take a look at what oil and copper did. Copper was down about 15%. You're saying that makes sense. If people expect the economy to slow down, copper should be down. But oil was down more than 50%. In 5 weeks, oil prices dropped more than 50%. What did I read into it? There's something else going on in the oil market that goes well beyond what people think about the economy. In fact, there are two oil prices I've tracked on this graph. One is the price of Brent oil, which is global oil, and the other is West Texas crude, which is US oil. And on April 19th of 2020, something happened that I never thought could happen in markets. Remember I said price has no upper bound and lower bound? Let me take that back. I used to think price had a lower bound of 0. How could price be lower than 0? And on April 19, 2020, you know what West Texas crude traded at? Minus $30. Minus $30. What does that mean? People trying to sell West Texas crude had to pay people to take oil off their hands. You think that makes no sense? It actually makes complete sense, because you know what happened? Storage capacity in the US had run out. So if you bought oil, there was no place to park it. So you had to actually pay people to take oil off your hands. But the bottom line is, just as with stocks and corporate bonds, take a look at what's happened since March 20th. There's been a recovery. In fact, copper prices are now up relative to where they were before the crisis. And if you look at oil, it's not, I mean, it's reversed some of its losses, but it's still down about, I mean, it's down still 30%. So oil and copper have tracked the crisis, and it reflects what, so what I'm saying is it's not just stock markets, it's bond markets, it's commodity markets. And on page 9, I looked at two crisis assets. One is a long-standing. I looked at gold. Why? Because what's the story about gold? When people get scared, they buy gold. I mean, I don't have to tell Indians this. For centuries, this is what people have done, right? When you get scared, what do? You sell everything, you buy gold. I don't know where you hide it, but you put your money in gold. And in this crisis, gold has held up. Perhaps not as much as people who invest in gold all the time would hope, but gold prices are up during this crisis, reflecting the fact that people have bought gold because they were scared. But you know what the other crisis asset I've tracked here? It's Bitcoin. Why Bitcoin? Because for the last decade, what I've heard from Bitcoin advocates is one reason to buy Bitcoin is when people lose faith in paper currencies and governments and institutions, they will buy Bitcoin. Well, it clearly hasn't stood up to its role as a crisis asset during this crisis. Because take a look at what Bitcoin did between February 14th and March 20th. It was down 50%. When stocks were dropping, Bitcoin dropped even more. As stocks recovered, Bitcoin recovered even more. Bitcoin has behaved like really risky equity, not like a crisis asset. I'm not saying Bitcoin is a good investment or a bad investment. That's up to you to decide. But if you're holding Bitcoin because you think it'll hold its value when everything else melts down, think again. Bitcoin is behaving like really risky stocks. It's not going to diversify your portfolio. It's just going to make it more risky. Something to think about if you have a substantial amount of your money in cryptocurrencies. So I've showed you what's happened across different asset classes. Now I'm going to talk about something I've been doing every week for the last 18 weeks. One of the things I do every Friday, so if you turn to page 10, you would see the breakdown by region, is I've downloaded the market cap of every publicly traded stock in the world. Sounds like a lot of work, right? But in today's day and age, it takes me 15 minutes after markets close around the world on Friday to download the data on 40,000 plus publicly traded companies. And here's what I do. I then look at the change in market cap on every company, and I aggregate, and then I slice and dice the data. You're saying, what do you mean slice and dice the data? Well, if I showed you 44,000 companies, you could just drown in data. So I consolidate them by region, by sector, by PE ratio. I want to see where the market is inflicting the most damage and where it's inflicting the least damage. Who are the winners and who are the losers? Remember, crises create winners and losers. And I'm going to point to some of the winners and losers. But the way I do this is by looking at the data. This is something we could not have done 10, 20, 30 years ago. We now have the access, might as well look at it. So the first thing I do every Friday is I look at the damage by region. So if you look at this particular table, you see my breakdown of the damage done during this crisis by region of the world. Okay? Now, if you look across the world globally, just to give you a sense of the amount of damage that was done in dollar terms between February 14th and March 20th, collectively, global stocks lost $26 trillion in market cap in 5 weeks. 26 trillion gone. They've recovered somewhat. In fact, by the time you get to June 12th, global markets are down. They're still down. They're down about 3.6 billion. But that's down from the 26 billion. Global markets have almost come back all the way. But take a look at the last column, because you can see which markets have seen the most damage during this crisis. It's Africa, Latin America, India is up there. Right? It actually is more damaged than much of Asia, and the UK. The UK is, in fact, the only developed market that shows up in the mix. Emerging markets have been damaged more than developed markets. And among emerging markets, Brazil and India have been damaged a lot more than China and Russia. In fact, as I go through the rest of the session, I want you to think about clues as to why Brazil and India. Part of it might be that the virus is being much more deadly in those two countries. Part of it might be the types of companies that are listed there, but you can see the differences by region. As I said, keep thinking about why there are differences across regions, because on page 11, I have the breakdown by sector. Take a look at the breakdown by sector on page 11, because you're going to see which sectors of the world have seen the most damage and which have seen the least damage. Take a look at the last column. The best performing sector during this crisis period has been healthcare. Any surprises there? No, really, it's a virus-driven crisis. Of course, healthcare is going to do well. Next best is technology. Then you have consumer goods, both staples and discretionary. Those are the 4 best performing sectors. What are the worst performing sectors? One is energy. No surprise there. Oil prices are down 30%. Of course, energy is going to be affected. Second is real estate. Third is utilities. What do they share in common? Utilities, real estate, energy, big infrastructure sectors where you have lots of investment funded with a lot of debt. One of the things that this crisis has highlighted as a weakness is companies with a lot of debt are being punished more than companies that are lightly burdened with debt. The best performing sectors tend to be capital light. But the worst performing sector of all, take a look at the last column. What do you see? Worst performing sector of all is banks. Why? Because banks live in reflected glory and reflected pain. What I mean by that is if oil companies get into trouble because oil prices are down and they cannot make their debt payments, guess who pays the price? It's banks. Banks are always going to be in the heart of every crisis because especially if the crisis is causing defaults, banks are going to feel it. In fact, I took the sectors and on page 12, I broke it down into a little more detail into industries. So take a look at page 12 because you're going to see the industry winners and losers. And you tell me whether you see a pattern. So basically, I have the 10 best performing industries and the 10 worst performing industries. The 10 worst performing industries, you're going to see a disproportionately large number of capital intensive businesses with a lot of debt, with a few financial service businesses thrown in. And the best performing businesses have been a mix of healthcare and technology. This has been a crisis that has been much kinder to capital light businesses and capital intensive businesses. And you see that play out in the numbers. So if you check my blog by later today, I will have the update through July 17th, and you can see how the damage gets updated as you go through weeks. So let me sum up what I've learned about markets over the last 18 weeks. I've actually acquired more respect for markets now than I did 18 weeks ago. Now, I'll tell you what I feel about markets. I believe that markets make mistakes. Don't get me wrong. But the one thing you can never do is treat them with no respect. Always respect what the market is telling you, even if you disagree with it. Because in the midst of chaos, there's always order. In the midst of all of this chaos we see in markets, there's been a remarkable amount of order. Yesterday, I was on a webcast and I described this as the most orderly crisis I've seen in my lifetime. What I mean by orderly is if you dig deeper, there's a reason why markets are picking winners and losers, and it actually makes sense. Unlike 2008, where markets were selling everything, this is a crisis where not everything is being sold. The companies that are being sold, in a sense, deserve to be sold, and the companies that are winning, in a sense, deserve to win. So that's the first big lesson. Don't let the experts tell you markets are crazy. In fact, the minute you call markets crazy, you're setting yourself up. And on page 13, I've summarized it. You're setting yourself up for disappointment because you have to give respect to markets to try to understand what they do. Early in this crisis, there was talk about, hey, we should shut markets down. You remember, the first 2 weeks, let's shut markets down to the virus. Thank God people did not listen. Because in a crisis, you have to let markets work it out. Liquidity is a salve. It's not going to exacerbate. It's the thing that's going to get you through this crisis. So if you turn to slide 14, now I'm going to go to my second lesson. During this crisis, I've heard people get on CNBC. So if you turn to page 14, you'll see the next lesson. I've heard experts get on CNBC and tell me all kinds of things about markets. And one thing I've learned over my lifetime watching markets is don't listen to experts. Experts have agendas. And when they have agendas, they're going to find a way to push those agendas. Every crisis is an opportunity to them. I told you so. So one of the things I heard early in this crisis, especially in the first 2 weeks, is a lot of old-time value investors. You know who I'm talking about, right? Some of you in the audience might call, I'll give you the clues as to whether you're an old-time value investor. You like to buy low PE stocks with high dividends. You think that's the recipe for making money. You probably have a picture of Warren Buffett in your house, and every morning you worship at that picture. You think that everything that Ben Graham wrote in Security Analysis must be true because he wrote it. I admit it, some of you are old-time value investors, and you've had a tough decade. What do I mean by a tough decade? If you look at page 15, I've actually looked at how stocks, old-time value stocks with low PE ratios and high dividends have done relative to high growth stocks. And you've had a tough decade. Between 2010 and 2019, take a look at the last row. High PE stocks have done much better than low PE stocks. High price to book stocks have done much better than low price to book stocks. And you've suffered. I mean, even Warren Buffett has become human, right? His investing looks a lot more like everybody else's. He's had trouble beating the S&P 500. And during this decade, value investors have been frustrated and angry. And they've been wagging their finger saying, you know, just wait. A crisis is going to tell you why value investing is better. So when this crisis started, they said, hey, you know what? If you just listened to us and bought low PE stocks with high dividends, you wouldn't be suffering. And I heard them. And then as the data started to come in, I said, let me check to see whether that's true. So if you turn to page 16, you'll actually see how low PE stocks versus high PE stocks have done during this crisis. So take a look at the top of that on page 16. If you look at the lowest PE stocks, are down about 15%. The lowest PE stocks are down about 15%. Take a look at the highest PE stocks. They're down only 3%. Hey, if I'd listened to your advice and bought stocks with low PE ratios, I'm feeling more pain now. I've lost 15% of my value, whereas if I bought growth stocks, I wouldn't. In fact, stocks with the highest dividend yields have been punished more than stocks with the lowest. Companies that pay no dividends are actually up. Companies that pay big dividends have been punished. So if I'd listened to your advice and bought stocks with low PE ratios and high dividends, and even momentum has played out against you. Remember, momentum is you buy stocks that have gone up the most over the last 6 months. No value investor wants you to do that. But in this crisis, the highest momentum stocks have done better than the lowest momentum stocks. And you can see this on page 17, where I track out what stocks with different momentums have done over the crisis. So here's the bottom line. If I'd listened to old-time value investors and bought stocks with low PE and high dividends and low momentum, this crisis has been much tougher for me than if I didn't listen to them. Hey, I didn't come here to dump on value investing. That's for a different forum. I'll dump on them on a different point. My point is, experts will throw things out, and most of the time, and I hate to say this, they make stuff up. We have the data now to check these people. So when they say, hey, buybacks are the reason companies are in trouble, rather than just take them at their word, you know what I'm going to do? And I did this. I went and looked at stocks, and I looked at, at stocks and companies that bought back stock versus companies that did not. Say, is it true that companies that bought back stock were hurt more? And the answer is no. There's a lot of agenda-driven expert opinion here. Check them with the data, and much of the time you're going to find they fail. So on page 18, I'm going to point to the one culprit that I think I would highlight during this crisis. This to me has been the real culprit. Of all of the things I've tracked, the one thing that seems to explain best why some stocks are down more than others is how much debt they have. So what you have on this table actually is a breakdown of companies based on how much debt they have. And the way I measure how much debt they have is I look at the net debt to EBITDA. So basically net debt is debt minus cash, and I divide it by EBITDA. So the higher this number, the more debt you have. So basically I've broken companies down from lowest decile to highest decile. Take a look at the last column, and you can already see this is no contest. The companies with the least debt have done much better than the companies with the most debt. Remember earlier I talked about capital intensity? I don't think capital intensity by itself is the problem. I think the problem is many companies in capital intensive businesses have chosen to fund that investment with debt. Notice the word I use, chosen. When I talk to the CEOs of infrastructure companies and ask them, why do you carry so much debt? CEOs of airlines, why do you carry so much debt? You know what every time their answer is? Oh, we have a lot of investment to make. We have to borrow money. Why? Why can't you raise equity? You know what happens when you raise equity? You got to issue shares. And you issue shares, what happens? Control gets diluted. In many companies, control is the reason why these companies are borrowing money. And guess what? They're paying a hefty price. In fact, I plan to actually take Indian companies and slice them, dice them by net debt, because I have the numbers, And I'll wager that one reason the Indian market is down more than global markets is there are a lot of Indian companies with a substantial amount of debt. And that debt is now coming back to bite them during this crisis. So what's the bottom line? On page 19, I kind of wrap up my bottom line on value versus growth. If this was the crisis that was going to rescue value investing, think again. It's not going to happen. This crisis, value investing, has failed. Now, in my view, it's failed because it's lost its way. A few years ago, 4 years ago, I was invited to Omaha. You know what happens in Omaha every year? It's what I call value investing Woodstock. All these old value investors show up in Omaha to go to the Berkshire Hathaway meetings, to listen to Warren Buffett talk. I've never been to a Berkshire Hathaway meeting. I don't plan to be at one. But they invited me to come and talk to some of those portfolio managers. And I don't think they're going to invite me back again. Because I told them what I thought was wrong with value investing. I said, value investing has become rigid. Think of all the rules in value investing. You buy a stock with the price to book is less than 1, the price earnings is less than 10, the dividend yield is greater than 4%. It's rigid. It's ritualistic. There are certain things you're supposed to do, like a Hindu religious ceremony. There's a sequence of things in value. You have to do this, and then you have to do this, and don't get the sequence wrong, or everything's going to blow up. And it's extraordinarily righteous. Value investors think that they have the one true way to making money. Everybody else is shallow, has lost their way. Rigid, ritualistic, righteous. And in investing, those are 3 very bad characteristics. But I'll leave you with at least a dose of hope if you're a value investor. I believe I'm a value investor. I'm not the kind of value investor who's going to go to Omaha and read Ben Graham and listen to Warren Buffett. But I believe we have to have a much more dynamic, open view of value. And I'll tell you what I mean by that. Last June, I bought Tesla. Now you're saying, that's crazy. Why would you buy that crazy stock? It's losing money. It's a growth company. Hey, where in value investing does it say I can't buy a growth company? The essence of value investing to me is that the price is less than the value. Nowhere in there does it say it has to be a mature company. We have to rethink the way we think about value if we want value investing to be rescued. We can't leave it in the hands of old-time value investors who think a low PE and a high dividend means you bought a cheap stock. We've got to let go of that. Because this crisis, if nothing else, has reinforced the notion it doesn't work. So let me turn to the next lesson on page 20. Actually, before I go to the next lesson, on page 20, I have one of my favorite structures in investing, and I use this all the time. So if you look at page 20, I have what I call a corporate life cycle. I believe that companies, like human beings, are born as startups, and then they grow as teenagers, and then they become, the peak of their lives. Think of this as you're a 25-year-old, then you become middle-aged. What's to be middle-aged? But enjoy your middle age, because after middle age comes old age, and then you die. I know, very morbid thought, but companies go through that life cycle as well. And in this crisis, young companies have been treated much better than older companies, because in most crises, young companies suffer more than older companies. You go back to 2008, it was young growth companies that faced the brunt of the damage. But in this crisis, if you turn to page 21, I've actually looked at what happened to companies during this crisis based on how old they are. Basically, I looked at the age of a company. I looked at when the company is founded, from youngest to oldest. So across the world, I've broken down companies from young to old. Take a look at the last column. The youngest companies are down only about 3%. The oldest companies are down more than 10%. This is a crisis that has been much more deadly for old companies and young companies. In a strange way, it's kind of mirroring what the virus does, right? Because if you think about the coronavirus, it's actually much more deadly if you're 65, 70, 75-year-old. Same thing seems to be playing out with companies. If you're an old company, this crisis is having a much bigger impact on you than if you're a young company. And if you turn to page 22, I've broken down companies by growth. And guess what do we find? High growth companies are doing much better than low growth companies. This is a crisis that, for better or worse, is playing out in much worse ways for older, low growth companies than it is for younger, high growth companies. And on page 22, I present some of the reasons why. I think that if you look at page 23, I list three possible reasons. One is that this is a fairly unique crisis, right? Because I told you the crisis hit as markets were peaking. And what happened in the first few weeks of the crisis? The global economy shut down. That has never, ever happened in economic history, ever. I mean, we shut the entire machinery down of the global economy. The economy shut down first, and then markets had to react. Usually markets go into crisis and then the economy slows down. But this crisis is different. It came with a timer too, right? They told us, and they were lying then, that by the end of May or June, we'd all be able to go back to our jobs, everything would be okay. We believe them. And one of the things that has made this crisis unique, and that's going to be the subject of my post this week, is private risk capital hasn't gone away. In most crises, private risk capital goes away. You're saying, what are you talking about? Venture capital, IPOs, investing in growth companies. Those things usually die during a crisis. In this crisis, not only have they stayed in the game, they've actually invested more. Venture capitalists are still continuing to invest. And in India, of course, you've seen this play out in a very high-profile story, right? How much money has Jio raised during this crisis? I mean, think about this is a crisis. You're not supposed to be investing in risky, money-losing ventures. Jio's had no trouble raising money. If this had been the 2008 crisis, Jio would not have been able to do what they did. This crisis has been different. So second lesson, look at the data. The data is there. Don't let experts tell you what's going on. Check the numbers. Third lesson, this is something that some of you will not hear on page 24. I want to talk a little bit about smart money and stupid money. You've heard the legend, right? Smart money gets into markets at the right time, buys the right stocks. Stupid money gets into markets at all the wrong times. And at least in this legend, who's the smart money? Professional money managers, people who run mutual funds, people who work at investment banks. They're the smart money, hedge funds. You know who the stupid money is? Retail investors, the great unwashed masses, because they're so ignorant. They invest based on emotion. I'll be quite honest with you, for 35 years that I've been in markets, I've been on a search for smart money because they keep telling me they're smart money. And you know what? I still haven't found it. I found a lot of smart people, but I've never found smart money. And for the last decade, we've had a contest between smart and stupid money. And guess who's been winning? On page 25, I create a graph that has given nightmares. I know every mutual fund manager in the world goes to bed every night saying, please God, let me not dream about this graph. You know what this graph is? It's a graph of fund flows into ETFs and index funds and out of traditional mutual funds. See the red columns there? That's the money flowing out of mutual funds. See the green columns? That's the money flowing into index funds and ETFs. That should strike terror in your heart if you're a professional money manager, right? Because what's happening? Your share of the investing market is shrinking dramatically. And why is it happening? For a very simple reason. Remind me again how much the average active mutual fund manager beats the market by each year. So let me ask you a different question. What percentage of active money managers beat the market? You're saying which market? And let's take the Indian market. You know, S&P tracks what percentage of active mutual fund managers in India beat the market, right? You know what percentage have actually beaten the market over the last 5 years? 19%, 19%. 81% of active money managers in India have underperformed the market over the last 5 years. And this is something that shows up in every market in the world. Active investing is losing market share for a very simple reason. It does a really crappy job with my money. Why would I pay 2 and 20 to you for you to lose 1.5% more than I could have made by just investing in an index fund? But while this was happening, you know what the smart money, the hedge fund managers and professional money managers were saying, right? It's just a passing phase. Just wait for a crisis. And if there's a crisis, you're going to see how much you need us being professional money managers. So now you have your chance. This should be the chance of smart money managers to shine, right? Hedge funds should have gotten out of this market early, should have gotten into the market. Same thing with mutual funds. Let's see if that's what's happened. Now, on page 26, I track what active mutual funds have done now during this crisis by looking at just the first quarter. If you go to my website, I have the second quarter and things have an improvement. So basically, I'm looking at how much the average active mutual fund has beaten the market by during the first quarter of 2020, which was the bulk of the crisis. And I have some really bad news. In the first quarter of 2020, at the height of this crisis, active money managers delivered 1.37% less than the market. Hey, if this is the reason I'm paying you is to save me from a crisis, you're not doing your job. Now, if you talk to hedge fund guys, they say those mutual funds are run by the stupid money managers. We're the smart guys. Okay, let's see what hedge funds have done on page 27. If you look at hedge funds and you track how hedge funds have done relative to the index, they haven't done well. But over the last few weeks, there's actually been a phenomenon that actually has been one of the most humiliating things that hedge fund managers have had to deal with. Now, whether you've heard of the Robinhood phenomenon. Robinhood is a trading app that a lot of, not just retail investors, that a lot of, in the US, there's a big chunk of people who gamble on sports. That's their notion of investing, is they bet on football and baseball and any sport they can, and they've had nothing to bet on. So the Robinhood app has actually attracted many of those people. And you can define these people. They know nothing about markets and stocks and valuation. You know what they've been doing for the last 5 months? They've been buying a lot of stocks in the Robinhood app. So you know what this graph is? It's how those people who know nothing about markets have done relative to those hedge funds that you're paying 2 and 22. And over the last 5 months, the Robinhood app investors have beaten hedge funds by 16%. This is the most humiliating graph ever, right? Because here you are, you call yourself a hedge fund manager, you have this great pedigrees, you have these best analysts, have the biggest computer of all this data, and there's this guy sitting in a bar buying one stock using a Robinhood app. He's never invested before and he's beating you. I'm not saying Robinhood app investors are going to, Robinhood app traders remind me of guys at a casino at 11 o'clock at night. They've made a big killing, they have a lot of money, and they're continuing to gamble. You know what's going to happen to them by 6 a.m. the next morning, because they're going to gamble through the night? By 6 a.m. the next day, I can almost guarantee you they'd have lost all that money. So these Robinhood traders are going to end up losing what they've made, but my bottom line is they've revealed the emptiness of much of what you see as investment expertise, because with no ammunition, they've beaten the hedge fund army. So here's the bottom line. I don't believe there's such a thing as smart money. And I don't believe there's stupid money. That's hubris to go around saying, I'm the smart money, you're the stupid money. I don't believe retail investors are stupid. I don't believe professional money managers are smart. So if you turn to page 29, I'm going to give you, 28, I'm sorry. I'm going to give you a different categorization for money. Hey, you have a lot of money to invest, and you're looking for somebody to invest that money for you. Don't look for smart money. Look for humble money. What's humble money do? When it makes money, it realizes the biggest reason it made money was because it was lucky. It was at the right place at the right time. In contrast, arrogant money, every time it makes money, it's my system, my approach. Humble versus arrogant. Humble money, when it makes a mistake, admits it makes a mistake and fixes it, tries to do things right. Arrogant money, when it makes a mistake, always blames somebody else. Ask yourself a question. I don't know when you last met a hedge fund manager. When was the last time you met a humble hedge fund manager? It's been a long time. It must be built into the job description that if you're going to manage a hedge fund, you must have hubris, that you must have gone to the right schools. I am looking for humble money, not arrogant money. And this crisis has brought home that lesson. The fourth and the fifth lessons I want to compress because, partly because there's more detail in them and partly because I'm getting to the end of, so I want to give you guys a chance to ask questions if you have any. So lesson 4, which is on page 29, one of the things I hear every time there's a crisis is the fundamentals don't matter anymore. You're in a crisis. So I want to re-emphasize something that we should not forget. In the midst of a crisis, go back to basics. Remember your fundamentals even more than ever before. I'll give you a very simple illustration. I've been valuing the market, the S&P 500 every year for almost 40 years. I'm not a market timer, but I still value the index. So I'll tell you how I've always valued the index. I've valued it by getting the expected cash flows from buying the stocks in the index. In the US, that takes the form of dividends and buybacks, and discounting those dividends and buybacks back at a rate of return that investors demand for investing in stocks collectively, which is the risk-free rate plus an equity risk premium. I take expected cash flows and discount, I get the value of the index. That's how I valued index in 2019, 2018, 2015, 20. So I've always done this. So now we had a crisis, and I remember putting up this graph early in the crisis, and people said, you can't do that anymore. And I said, why? So we're in a crisis. Those things are for regular markets. In a crisis, it's going to be different, right? And my response is, hey, let's turn to page 31, and you're going to see the classic pushback as to why the fundamentals don't matter. So on page 30, if you look at the 2 reasons people are troubled by what's happening with stocks. The first is, if you look at what stocks are doing relative to what the economy is doing, it looks like there's a disconnect, right? You know what I mean by a disconnect? Let's face it, around the world, economies are in trouble. Unemployment is going up, production is down, consumer confidence is down. And that should be no surprise. In fact, when people act surprised by this, I tell them, look, I mean, if you park your car in your driveway and you go check the speedometer after it's parked, what are you going to see? That the speedometer is 0. Don't be surprised that you're not going 50. You park the car. If you shut the economy down, is unemployment going to go up? Production going to go down? Absolutely. But one thing that surprises people is the fact that the economy seems to be in trouble, but markets are going up. How can that be? And there are some people, at least some experts, who think the market is in denial, that it's missing all this bad stuff that's coming down the pipe. I don't know whether the experts are right or wrong, but if you turn to page 31, now click forward a couple of slides, you'll see a graph where, so go one more slide, 31. You'll see a slide where I graph out 2 series. The first is, the green series is the quarterly returns on the S&P 500. I'm sorry, the red series, the quarterly returns on the S&P 500. The green series is the real GDP growth in the US. Basically, it's a measure of how the economy is doing. So basically, I'm graphing stock returns against how the economy is doing. I know it's been a long time since your statistics class, but I'm going to draw on some very basic statistics. I did a correlation between stock returns and real GDP growth in the same quarter. So take a look at that table below. What do you see? You see a correlation close to 0. Basically, there's almost no correlation in what stocks do and what the economy does in the same quarter. But if I go forward 1 quarter, 2 quarters, 3 quarters, 4 quarters ahead, it looks like the correlation goes up. In fact, stocks are good. I mean, if you look at the correlation, 3 or 4 quarters ahead, it's about 0.28. What does that mean? It's not the market's job to tell you what's going on right now. You already can see that. It's the market's job to try to forecast the future. So my first response when people ask, well, how do you explain the fact that stocks are going up even though the economy is doing badly, is, hey, stocks are going up because, for better or worse, the market thinks that the economy is going to be okay 4 quarters ahead. Now, you can agree or disagree with that notion, but that's what markets are supposed to do. So one of the things I decided to do, and this was early in June, so if you turn to page 33, you actually see my risk premiums over time. I'm sorry, what do you have? You see, I tried to value the S&P 500. I used that same structure that I use in any year, okay? And I decided to value the S&P 500. So this is on page 33, yeah, 33. I valued the index. So basically, I did exactly what I did in good times in the crisis. Because I said, look, just because you're in a crisis doesn't mean you don't buy stocks for cash flow. That doesn't mean you don't have to build in risk. So this was my valuation of the S&P 500 on June 1st of 2020. I'll cut to the chase. I do think this crisis is going to create real damage to earnings and cash flows in the near term for the S&P 500. Why? How can it not, right? So I built in the damage, much lower cash flows going forward. So you can see my projected cash flows going forward now are much, much, much lower. They're about 40% lower for 2020 than they were before the crisis. So I think I'm being realistic about the damage the crisis will create. The crisis has lowered my risk-free rate. Why? Because you saw the treasury rates are down. It has probably increased my equity risk. Why? Because I'm a little more scared now than I was 6 months ago. But here's the bottom line. With the lower cash flows and the higher risk premiums, the value that I got for the index was about 2,930. On the day that I did this valuation, the index was trading at 3,030, within 4% of my valuation. I'm not trying to justify where the market is right now, but I'm saying if you call the market crazy because it's trading at a high level, you haven't looked deeply enough at the numbers, because there is a plausible story that explains what the market is today. We can disagree with that story, but the market seems to believe that while this crisis will create short-term damage, that the long-term damage will be limited, that the markets will come back, the economy will come back. Now you can disagree with that, but that's what the market consensus seems to be. Now if you take a look at this valuation, I'm making assumptions about earnings and cash flows in 2020 and 2021, right? Could I be wrong? Oh, could I be wrong? I could be horribly wrong. I'm making assumptions about the risk premium. Could I be wrong? Absolutely. So here's what I did that I use as a technique whenever I'm worried about being wrong. I tell people how wrong I can be. You say, what are you talking about? If you turn to page 34, slide 34, the next slide, you'll actually see what's called a Monte Carlo simulation. A Monte Carlo simulation, what you do is instead of making a single estimate of each input, you put in a distribution. So I put in a distribution for earnings and cash flows and risk premiums. And in the Monte Carlo simulation, instead of giving you one value for the index, I gave you a distribution of value. So take a look at that graph at the bottom. That is my estimate, the value distribution of the S&P 500. And to the left of that, you see a table that lists out what I think the 10%. The reason I do this is when people say markets are crazy, I go and look at this table and say, are markets crazy? Or maybe you're just disagreeing with markets. It makes us uncomfortable when we have a point of view about the world that's different from the markets. But don't call the market crazy. Please take a look at what the market's forecasting, because remember what I said, you can disagree with markets, but you always have to respect the message that's built into markets. So if your conclusion based upon this crisis, I should let fundamentals go, I should come up with some new way of looking at markets, don't do it. Just go with the old ways, make your best judgments, and come up with your own perspective on whether markets are valued. In fact, I created a Google shared spreadsheet where I let people play with this spreadsheet, and they got a distribution of values that was much, 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 much wider. So that's my fourth lesson, which leaves me with just a couple of minutes on my final lesson. And I'll just talk about this. So on page 35, you have a picture that I use to introduce what I think is a lost lesson in valuation. Over the last 40 years, I've seen valuation kind of devolve. You know how you evolve? Valuation is devolved. Devolved because we have more data and more tools. That sounds weird, right? You're saying if you have more data and more tools, valuation should get better. They've actually, in my view, become worse. Why? Because most valuations now have become Excel spreadsheets. Most valuation classes have become classes on how you can become an Excel ninja. So we turned over valuations to spreadsheets. And for the last 4 years, I've been preaching this mission. I've been on a mission saying, look, we've lost sight of what it is that makes for good value. A good valuation is a bridge between stories and numbers. And if that sounds mysterious, I have an entire Google talk on how to connect stories and numbers. So before this crisis, I was pushing that agenda. I said, look, if you want to value companies, rather than opening a spreadsheet and plugging in numbers and being mechanical, tell a story about the company and convert that story into a valuation. So we go to my blog early in January of this year. I valued Tesla. Tesla is the ultimate story company, right? Because how much value attached to Tesla will depend on whether you think it's an automobile company or a tech company, how much it will grow, how it will change the business. So I value Tesla with a story. In fact, I created a blog post where you could value Tesla on your own, a do-it-yourself valuation of Tesla. So that was in January of 2020. And then the crisis hit. And then people start asking, do you still believe what you said before, which is, you've got to tell a story. We're in a crisis now. And I said, more than ever before, you need to tell stories now. Because if you're mechanical and you just project numbers out, you're going to be in deep trouble now because your numbers have stopped having meaning. Let me explain. If you try to value Boeing today using the most recent year's numbers, you're going to crash and burn. Why? Because the most recent year's numbers don't reflect the pain that's going to come out of this crisis yet. More than ever before, I feel the need to tell stories. So I won't get a chance to go into this detail, but 2 weeks ago, I've revalued Tesla. Just to give you some perspective, in January 2020, I valued Tesla around 420. Now, the story I'm telling for Tesla is bigger, more lucrative than the story before. You say, how can a crisis make a company more valuable? You know what this crisis has done to Tesla? It's punished its competition. It's handicapped traditional automakers, GM, Ford, Volkswagen, Daimler. Why? These are big capital intensive companies with a lot of debt. And remember what I said about how this crisis damaged those companies? There are two ways you can gain as a company. One is you can do really good things. The other is your competition can do really bad things. And for Tesla, its competition has become weaker. I mean, the analogy I would offer is when people look at Amazon today, $1.5 trillion company, ask them, how did Amazon become the company it is today? You know, the answer you usually get is the .com boom. No, that's not why. You know what made Amazon the company it is today? The .com bust. In 2001, when the .com bubble burst, here's what happened. All of Amazon's online competition got wiped out. And its traditional brick and mortar retailers, the Walmarts, the Targets, got so damaged that they said they were not going to sell online anymore. They left the entire business for Amazon to dominate over the next 4 or 5 years. Biggest mistake ever. Because Amazon used that period to not just dominate the online retail business, but to dominate retail overall. Tesla is a window of opportunity now. Traditional auto companies are so damaged and so paralyzed right now. Remember all those electric car plans that everybody is making? They're all in the back burner now. You have to survive to get there. So the Fords, the GMs, the Volkswagens are too damaged right now. Tesla can go out and do whatever it wants. I'm not saying Tesla is going to pull it off, but my value for Tesla 2 weeks ago was $620, up from the 420. Bigger story. I wouldn't buy Tesla at 1,500. That's a bridge too far for me. But my point is, when I tell a story now, I've got to reflect how the crisis will affect that story. There are some companies where this story is going to make the company zoom. And I'll give you an example of a company that's going to zoom. Zoom. You know how many webcasts I've done on Zoom in the last 5 months? I've lived my life on Zoom. I've taught all my regular classes I taught on Zoom. This is a company that has seen its market almost double because of this crisis. And guess what? After this crisis passes, Zoom will be a much bigger, more expensive company. Peloton, a company that before this crisis had a very limited niche market, but because so many people are exercising at home, much bigger market, much bigger value. If you're a cruise line company, the crisis has permanently damaged you. Would you ever want to get on a cruise ship again, even after this virus passes? I wouldn't. So my point is, this crisis is going to help some companies and hurt some companies. And your job and my job in value companies is to have to ask the question, how will this crisis play out in my company? So whether you're valuing ITC or Reliance or Infosys, don't just look at the last 10 years of numbers. Look at how this crisis will play out in these companies. because that's what's going to drive the value of these companies. So it is a lesson that is being reinforced by this crisis, but be less dependent on Excel spreadsheets and historical data, and be more willing to be forward-looking, because nothing else. That's a lesson I've learned out of this crisis. So I've had my say, and as I said, almost everything I've said today, I've said in my posts over the last 5 months. So if you're interested, you want to dig a little deeper, there's plenty of data out there, and you can download the data and check for yourselves where the damage has been. But that's pretty much all I had to say. So there's still a few minutes for questions. If you have any questions, or if you have any, I'm yours.
Prof, thank you very much. It's an amazing presentation. We have a chat box on which my colleague Nitin is just compiling some questions, and he's receiving questions and sending it back to me. A few of the questions which I've received during the session, and I'll immediately begin with them, is one question has been repeated 2 times, is how do you value companies in negative interest rates when there is so much QE happening across the world, in US, in Japan, in Europe, and the whole interest rates environment has been distorted? How do you value companies? That's a question.
So that's a good question. It's a question I get asked repeatedly. In valuation, there are some things where you've got to take the karmic view. Now, the karmic view is, it is what it is. It's not in my control. Let it go. It is true. Negative risk-free rates freak us out. You know why? Because, you never see this in your classes, right? Or you've never run it. You say, what do I do? What are negative risk-free rates? In a discounted cash flow valuation, if your risk-free rate is negative, what's the first number it's going to affect? It's going to affect your discount rate, right? Your discount rate is going to be a much lower number. Okay. But is that the only thing it changes? When you have negative risk-free rates, you know what else it's signaling, right? It's signaling deflation or very low inflation and low growth in the future. So I'm going to give away why negative risk-free rates or low risk-free rates don't bother me in the least, or don't get in the way of my valuation. Those same low rates that make my discount rates low will also make my cash flows lower. Why? Because the same low growth and deflation that keeps my discount rates low will also keep my growth rates and cash flows lower. Put simply, if you're worried that your valuations are going to explode because you have very low risk-free rates or negative risk-free rates, they're exploding because you're being internally inconsistent. What I mean by that is you're using growth rates and cash flows as if you lived in 2006, but your discount rates reflect 2020. It's that mismatch that gets us into trouble. If you're interested, you go to my website. I have a valuation of a Heineken from September of 2019 in euros. You know the risk-free rate in euros was in 2019? It was minus 0.5%. I didn't fix it. I've left it at minus 0.5%. I'll give you the good news. It made my cost of capital for Heineken really low, 5%. But it also made my expected growth rate for Heineken really low. Why? Because the same forces that make my interest rates low also affect my growth rates. I ended up valuing Heineken at about 59 euros, was trading at 95. I found it overvalued. The fact that I used low risk-free rates didn't cause my value to explode on me. So rather than spend your time worrying about interest rates and exchange rates and how the economy will be doing, just do your damn job, value your company, focus on the company, let the rest of the world kind of spin out there. Because if you spend 80% of your time worrying about risk-free rates, and then at the very last minute, oh my God, I have a company to value, you're going to have a really bad valuation. So worry about the things you should be worrying about and let the rest of the world just play out in your valuation.
Second question, Prof, is saying that today, when the management of the companies themselves are saying that we can't predict future, they're withdrawing all guidance that they have given or stop giving guidance.
Thank God for that. I mean, if you're valuing a company based on management guidance, that's like being a journalist who tracks a politician and believes everything a politician says. Now, come on. Why would you ever listen to management? If you're valuing a company, why are you listening to management in the first place? I mean, they might know more about the company than you do, but they're an incredibly biased source I have never in my lifetime valued a company with management guidance. Why? Because if I value a company with management guidance, whose story am I telling in my valuation? I'm telling the management story. And if I'm going to invest based on that valuation, I want to invest based, I will listen to management respectfully. But the ultimate judgment has to be mine. The reality is, we're in an environment where everybody faces uncertainty. Do you think Elon Musk knows what's going to happen over the next year at Tesla? No. So I have to accept the fact that we use the false security of saying management must know what's going on. Therefore, I'm going to use their projections of, come on. They're just as confused as you are. And even if they refuse to admit it and give you a number, don't use that number. It's your job and my job to come up with our own stories for companies and our own numbers. So thank God guidance has been pulled back. I thought that was one of the most negative things I've seen happen in markets is this practice of providing guidance. And an analyst valuing companies based on the guidance. That's not what we're supposed to be doing.
Prof, since Dr. Sao is here, a very interesting question raised by one of my colleagues. He says, how do you value stressed companies, especially 2 points? Because one, there is a great uncertainty in how things will shape up, and secondly, there is a very shallow depth in the market. And if I can say about that in India, there's a lot many stressed companies with all the challenges. So both the things are playing out. Very, very shallow depth in the market and greater uncertainty. Now, how do you value stressed companies in such situations?
Okay, let's take the first part. When you say there's a lot of uncertainty in evaluation, what are you saying? Your estimates of growth rates and cash flows and discount rates could be wrong, right? Remember that distribution I showed you? Uncertainty is a feature, not a bug. So we can complain about how much uncertainty we face, but let's be real. Everybody faces that same uncertainty. You're not special. So make your best estimates, accept that your value has a much bigger range around it, because that's what it means. But it's not that you can't value companies, but that your value range is much wider. That makes you uncomfortable, because when your client asks what's the value of your company, you give them a number, but inside you say, oh, I could be wrong, I could be wrong. It's okay to be wrong, because there is real uncertainty. On the second issue, remember that graph I showed you between price and value? Liquidity, or the lack of depth, is a pricing issue. What does it mean? You could be right about value, but because there's no liquidity, the price may not move towards the value. That's kind of scary, right? Because you're saying, I'm right, how do I make sure it's right? And this, I think, is why if you're investing in illiquid companies, you need really long time horizons. Unfortunately, professional money managers, you know who sets your time horizon? It's your clients. Your time horizon is only as long term as your shortest term client. So if you have a 6-month or a 1-year time horizon, it's right to worry about liquidity, but it's not because you can't value companies, it's because you're not giving enough time for the price to adjust to value. Because one of the things liquidity does, it makes that convergence process quicker. So again, it's not an issue of can I value the company, it's worrying about how do I get the price to move towards a value. It's good to separate what you're worried about. And with liquidity, you're worried about the second question, how will price move towards a value? It's not about the value per se. I mean, at the very limit, if I'm valuing a company that never gets traded, I can value the company, but what the heck do I do, right? The price will never adjust to the value. That's what liquidity does, is you can be right. It becomes very difficult to make money of being right. And as investors, we worry about that, and we need to worry about it, which is one reason why many people end up avoiding those mid-market Indian companies, because you could be right about value, but the price may not get a chance to move towards value in you. But if I'm a really long-term investor, you know where I'm going to find the best opportunities? In those companies. And I will buy the companies, but so if you're really willing to wait, you have 10-year, 15-year time horizons, I think it's an opportunity to not have liquidity. Because everybody else is running away, you can go to those companies, collect the cash flows, and eventually hope that the price adjusts to value.
Prof, one more technical question which has just come, which they say that the cost of equity and the cost of debt are moving in divergence. So with interest rates falling, the cost of debt is
they're not. No, wait, that's not true.
And the cost of,
how can they move in different directions? The base is the same for both. You start with the risk-free rate. How can interest rates be falling and the cost of equity be going up? Something's wrong with your calculation. So interest rates being low can't make debt cheaper than equity. They both go down and they both go up as risk-free rates go down. So when I valued Heineken with a minus 0.5% rate, the cost of debt was low, but so was the cost of equity. So this notion that if interest rates go down, cost of debt goes down, but cost of equity stays high, there's something conceptually that's not clicking for me. So lower risk-free rates don't make debt cheaper and equity more expensive. There's something too rigid about the way you compute cost of equity that's leading to that. So fix that problem, because that is a problem.
Okay. One more question, which has just come. This saying there are companies like the hospitality companies, Airbnb, Oyo, which may have a very, very prolonged impact of this crisis. Now, people, it may fundamentally change the way people look at things. So how do you value Oyo or Airbnb, given that we don't have visibility for maybe 2 years?
You know what? If you're an investor, be glad you invest in Oyo and Airbnb and not in Marriott and Hilton. You know why? Because Marriott and Hilton are being hurt a lot more by this crisis than Airbnb. And the reason is very simple. They actually have physical investments. Those hotels they made that are now empty. What is Airbnb? I mean, you're right. Airbnb has maybe has less growth potential, perhaps because people will travel less. But it's actually being hurt less than Marriott has because it doesn't have physical assets. It doesn't have debt. So is the future for Airbnb and Oyo less lucrative than it was 2 years ago? Perhaps. Okay. But I'm not so sure that that's true. Are people actually going to, I mean, that's a judgment call. And right now, in the midst of the crisis, you're saying people will never travel again. I was told in 2009, people will never invest in a bank again. I was told in 2001 that people will never invest in young tech companies again. You know how long that lesson lasted? Within 2 years, people had forgotten they were all doing it. I'll make a prediction. 2 years from now, more people will be flying than did before the crisis. I could be completely wrong, but I'm willing to make that bet. So Airbnb, I think, is going to go public, and you're going to be surprised how high its market cap is going to be, because in a strange way, just as Tesla has gained at the expense of its traditional competitors, Airbnb emerges from this crisis stronger than it was going in, because the traditional hotel companies have been really handicapped by this crisis. Oyo is a different game. I mean, the reason with Oyo I'm always a little wary is who's the biggest investor in Oyo? SoftBank, right? The only reason we have a pricing for Oyo is because SoftBank keeps outpricing itself. Remember I talked about arrogant and humble money? Where would you put SoftBank? Who makes 300-year plans? A really arrogant man. With Oyo, the problem is the biggest investor is the most arrogant investor on the face of the earth. And this is a crisis that brings arrogant money back down to earth. So the Oyo, my biggest worry is they've probably been overpriced. It's a company that doesn't have a viable business model. It's hoping that SoftBank would carry it forward. But I'm not sure whether Oyo is more WeWork or Uber. It could be either. Right now, I don't know where it's going to go. It could end up like WeWork, just crashing and burning, or it can end up like Uber, kind of making its way into the public markets. We'll wait and see. Airbnb, though, I think is more like Uber than WeWork. I think it's going to come back. It's going to have, my guess is it's going to have a higher market cap coming out of this crisis than it did going in.
One particular question again, which was just flashed on the screen, is how do you value, again, real estate perspective in Indian context? One is how do you value real estate developers? And how do you value REITs, which are more yielding assets?
Well, let's forget about the investment part of it. How do you value the building you live in, or the apartment, the house you live in? How do we put a number on a house? What do we do right now, Andrew? We look at other houses that sold in the neighborhood. Yeah. Real estate is a pricing game. It's always been a pricing game. I've always wondered why people do DCFs in real estate, because the reality is, what's the biggest number in your DCF? That price you think you can sell the property for 10 years from now. This has always been a pricing game. So guess what? Whether you're a REIT, a real estate developer, or just somebody investing in a piece of real estate, don't operate under the delusion that this has something to do with rental income and DCF. This is all about pricing. And what is pricing driven by? Mood and momentum. And let's face it, for the last 20 years, Indian real estate has been on a mood upswing, momentum upswing. You see real estate prices go with a few blips. Will that last? I have no idea. This is a pricing game. If you ask me what's the value, why, how would I explain Mumbai real estate prices being higher than New York? I won't even try. This is a pricing game. There's no upper bound or lower bound. As long as there's a bigger fool out there willing to pay an even higher price, hey, guess what? You're going to buy at that high price. So will this crisis create more cash flow accountability in real estate? I won't hold my breath. Real estate people have always been pricing people, and the pricing game could be, could be a good one, could be a bad one coming out of this, but it's really a pricing game.
Just last question, perhaps. How do you see this whole impact of this deglobalization and strategic tensions between US, China, the trade shift and trade wars? I mean, many questions are being asked about it. How do you see?
Remember what I said about the karmic view and valuation? You have enough on your plate. Don't add geopolitics to it and trade wars. If your company is in the midst of a trade war, bring that into your story, do your valuation. Don't worry about who's going to win that election, who's going to be this. You don't do that for some other discussion. In valuation, we have too much. We already have to worry about without adding all of this stuff to our plate. Don't make yourself political commentator, geo-economic analyst. I mean, we have only so much time during the day, right? So it is what it is. I'm going to live in the world I'm in, not the world I wished I was in. And I'm going to try to bring that into my story, and then I'm going to move on. Life's too short to be wondering about those things. So I know that's not a satisfactory answer, but that's exactly how I think about it in the context of valuation.
Can you also explain a little bit more on the narrative versus Excel thing? You said you touched upon it in the last part of your session. Why is narrative today more important than Excel?
Because when you do an Excel spreadsheet on a valuation, what do? You take the last 5 years of financials, you put them in, and then you take each line item and you project it out. That's what valuation has become. A lot of valuation plays. You have all the right line items because you use the right textbook, hopefully mine, but anybody's textbook. And then you project line items. And if you have a mature company with a nice, stable history, this becomes almost trivial, right? I always wonder, why do you even need a person here? Couldn't you mechanize the process? And I did. Actually, if you have an Apple device, an Apple iPhone or an iPad, and you go to the App Store, you type in the word UValue. It's an app you can download for a phone, which does basically historical valuation, takes last year's numbers, and does a pretty good job of just projecting numbers. But how many companies are you going to be valuing where you're in a period of stability, where you can take last year's numbers and project them out? What I'm saying is, you can get away with being lazy and mechanical when times are good and you're valuing mature companies. But in the midst of a crisis, when everything is shifting under your feet, you try to put things into an Excel spreadsheet and project things out, everything's going to blow up. And it's happening across the world. I see valuation sent to me and said, I got a strange number on my valuation. What did I do wrong? And my answer is, you didn't value the company. You did an Excel spreadsheet. Less modeling, more valuation. And I think we've made things too easy for people to model. And I think they fall into the trap of it. If I project numbers in great detail, I must be doing things precisely. Let it go. Precision is the enemy of accuracy. Our job in valuation is to try to get our best estimate of value, not come up with a model that gives you the same number over and over again. This is why I don't think accountants should do valuation. To be quite honest, if you're an accountant, don't take it personally. Accountants are all about precision. I think fair value accounting is an oxymoron. It'll never work because accountants are psychologically incapable of doing valuation because they want precise answers. The nature of valuation is You have to live with imprecision. You have to be okay being wrong. Why? Because you're not God. You don't control the outcomes. Things can change. Your story can be wrong. And you have to be willing to leave that door open so you can fix your story and get a better valuation.
So as you speak about the accounting part of things, I mean, there's so much impairment loss being booked by
What
large.
an insane waste of time. When was the last time an impairment actually made an effect in the market? This is a kabuki dance. Who cares? Impair what you want, don't impair what you want. This is the biggest, you know what, it's it's great for appraisers, because let's face it, fair value accounting has been a gift from heaven for appraisers. Without it, 80% of your business would disappear. But who really cares what you do? I mean, accountants actually operate in the delusion that I actually look at the balance sheet. Of all of the financial statements of a company I look at, the balance sheet is the very last one. I really don't care what you tell me the value of assets on the balance sheet, what you tell me shareholders' equity is worth, because I know exactly how late you are to the party. By the time you impair an asset, you know when SoftBank impaired its WeWork investment, you know when they did it? In November of 2019. By the time they did it, everybody in the world already knew that WeWork was worth nothing. So now they tell me it's worth nothing. No surprise here. By the time accounting gets around to impairing an asset, the party is done. This is like a person who shows up at 11 a.m. for a party that ends at 10 a.m. It's over. And I think that, so that's why I don't spend too much time on accounting valuation, because I think it's pointless for the most part. By the time, I prefer to value things for a transaction, for something happening. And accounting valuation, unfortunately, is like moving the deck chairs in the Titanic. After you hit the iceberg, you're still going to sink. No matter what you impair my goodwill by, you're not going to stop me making bad decisions. And I'd much rather do my valuation where there are actual consequences to my value. I hate to say that, because I know there are quite a few people in the audience who are accountants or appraisers who do impairment estimates. And I wish you the best, but every day I would get down on my knees and thank you, God, for not making me an accountant, because I couldn't do that. I mean, I would just go crazy.
So there are multiple more questions, but I don't know if we have time. We are already up more than 15 minutes.
Go ahead. Yeah.
There's, I don't know if the question is, how do we forecast a cash flow, or the recovery, whether it is going to be U-shaped, V-shaped? How do I forecast a company's cash flow? That's a question which has come. It's difficult for me to forecast while I'm an analyst. This is the question.
Well, I mean, it's a question. Is when you say difficult, you say you can't forecast. Would you mean when you forecast a cash flow, you're not sure about the cash flow? Because when people say they're difficult, it just means that, hey, remember what I said? Uncertainty is a feature, not a bug. And when I sit down to forecast cash flows in Boeing, do you really think I think those cash flows are going to be? No, these are my best estimates, given what I know about Boeing today, given what I think Boeing can do in the future. Less is more here. I mean, that's the essence of humility, is recognizing that none of us is special. There's nobody out there who has perfect certainty. We're all trying to make our best estimates, given the uncertainty we face. And here's the thing, if you're willing to be wrong, you can forecast anything. And that's okay. It's okay to be wrong. If you're willing to say I was wrong, it's amazing how it frees you to make forecasts on things that you otherwise wouldn't have forecasted. So be willing to be wrong, make your best judgment, but be willing to revisit that judgment.
So one last question. So it says that when the market is suddenly getting dislocated, as it happened during this crisis or previous crisis, I mean, earlier, just prior to the crisis, the market consensus was different and you were valuing things differently. Now, all of a sudden, possibly some shock happens and you get dislocated suddenly. So how do I value, because it is impossible to predict such things. And
Rajiv, let me ask you a question. On February 11th of 2020, what were you doing? You were in your office. You had lots of people around you. Let me ask you, what will you be doing next week on February 11th? If I'd asked you, what will you be doing a week from today? Your answer would be, it's a stupid question. It's going to be a Tuesday. It's a working day. I'll be here. March 23rd, the Indian shutdown started, right? You're saying, if I'd asked you February 11th, how come you're not forecasting that 6 weeks from now, the entire Indian economy was shut down, you will not get back into your office for 3 months? You'd have said, you're crazy. Do you see where I'm going? This is, I mean, people act as if the market is some all-knowing, all-seeing, but it's a collection of our views. Early in February, the collective consensus was, this is going to be a crisis. It's just like the SARS virus or some other flu virus. It'll come and go. Nobody saw this coming. Nobody. Did it change? Yes, because this is one of those things where, I mean, it's like, you know, you know, in insurance, there is this term for something that happens that's out of our control. It's called an act of God. What makes you think at valuation there will not be acts of God? This was an act of God that was a macro act of God. It's almost like God said, I'm tired of these people growing. I'm going to send them a shock. And guess what? It happens. You got to deal with it. The one thing you cannot do is go into denial. Act like nothing's happened. But at the same time, you can't go into panic either and act like everything has changed. This will not be the last crisis. If you're a young analyst, this will not be your last crisis. There will be others along the way. And what I want you to remember are the things you feel during this crisis. Hold on to them, because you will forget them after the crisis. Hold on to that fear factor, which is how terrifying it is when everything gets out of control. Because that feeling is what's going to make you a better analyst during the next crisis, because it's so easy to forget and revisit the same lessons over and over again. And one reason I've maintained this almost journal every week is I want to remind myself of how I'm feeling in real time during the crisis. And I'm 12 chapters in, and each chapter is at a different point in the crisis. I go back and read how I felt on February 26th without the benefit of hindsight, without judgment, because space February 26th, I felt that this crisis would be over by the end of April or May, and we'd be all back to doing what we did. I'm not going to go to second guess myself. How come you didn't see what was going to happen in June? We have to make our best judgments at the point in time that we make them with the data that we have at that point in time. It's not fair going back and saying, how come you didn't see this coming then? Because nobody did.
Great, sir. I think every word that you speak is worth its weight in gold. Before we
hopefully not in Bitcoin, but gold out there.
It is worth in weight in gold. And you know, gold is more than 50,000 rupees today.
Yeah.
So, so we have 1,400 people who have logged into watching this on this webinar. We are live streaming it on YouTube and putting it on LinkedIn. And I'm just told there are more than 400 people who have watched this on YouTube as well. So this is a good session.
So I'll soon be like the Kim Kardashian of YouTube, basically, you know, millions of views. So it's good to be a celebrity. Thank you.
No, you are indeed a celebrity, and I must thank you for, and Sahu sir, you too as well.
Thank you.
Thank you, Dr. Sahu. Thank you, Professor Damodaran. It's been a wonderful having both of you. We are honored, and on behalf of all my delegates, I thank you for your time and for sharing your insights. I really appreciate it. Thank you very much.